Hi, I'm Steve. I'm going to share my thoughts on how you can achieve a better financial future. Please remember, I don't know anything about your situation, so think for yourself and use what fits. Welcome back to our conversation about the 7 secrets of successful investors. Here's why it's so easy to be too conservative. Investing in a CD sounds and feels safe. The principal or amount you put in is guaranteed. You won't lose any money. But it's actually the riskiest thing you could do for long-term goals. You're likely to do little more than break even with inflation versus make 7% a year with the S&P 500. For a long-term bet, learn to live with the ups and downs of the stock market and reap the superior returns. In 1970, the S&P 500 was 92. This year, it hit 2,500. It bounces around a lot, but give it plenty of time and it's a great wealth generator. The third investing secret is that less can be more. Overactive investors who try to time the market, pursue hot stock tips, and in general engage in a lot of trading usually don't win. They rack up more fees and subject themselves to the human emotions of selling when scared and buying when happy. Remember, if people could really tell the market was about to go up, it wouldn't, because everyone would want to buy, but no one would sell. And any master of market timing would be very wealthy indeed. Here's another one. Be well diversified. That's just a fancy way of describing the folly of putting all your eggs in one basket. The idea here is to reduce the risks of investing by spreading your bets. Let me give you a couple examples. If you invested all your money in one company, you might hit a home run, but you might also lose everything. But if you invest in a mutual fund that contains 500 companies, you'll get a result that's more predictable. The companies that do well will offset the stinkers. Another type of risk is geographic. The US market might do poorly for a few years, but perhaps markets overseas will do well. Again, spread your bets for a steadier result. What we're really talking about here is avoid having all your money in things that are highly correlated, i.e. they react the same way to an event. A well-diversified portfolio will provide the best return for a given level of risk. Well, that's it for this session. Thanks for watching, and I'll see you next time.